Hello everyone and welcome to Insurance Business TV and the Q3 edition of our Cyber Insurance Power Panel. In this edition, we're going to delve into some common forms of cyber incidents and take a look at improving underwriting discipline as well. To do that, we welcome our experts. They are Derek May, Vice President, Technology and Cyber at Hub International, Ady Sharma, SVP Cyber Growth Leader at Aon, and Mila Araujo, AVP DigitalShield Personal Cyber Practice Leader North America at NFP. So welcome everyone, and we're going to start by reflecting on a QBE report that suggested more than 58% of Canadian businesses' cyber incidents were supply chain or vendor related. So with many firms now facing exposures from interconnected vendors, how should brokers integrate those vendor risk assessments, contractual indemnity reviews, and sublimits as well into cyber policies to address those rising third-party exposures in their client portfolios? So, Ady, any thoughts on this?
Yes, thanks, Paul. I think brokers and carriers have done a fair job asking clients about their third-party risk, critical vendors being used, due diligence that's being conducted before hiring some of these vendors, and what sort of contractual reviews are conducted on insurance applications right now. So the number of questions you can ask can never be enough, though, from an underwriter standpoint. And I think there may be room to dive deeper into the security posture, at least your top 5 or top 10 vendors. But currently, as we stand, cyber insurance does cover supply chain attacks in 3 areas. There might be more, but this is kind of the top 3 that it covers, which is number 1, network security failure of the insured that's resulting from transmission of malicious code from a third party. Number 2 is a privacy breach of the insured that's resulting from loss of confidential information by a third party, information that the insured is legally liable for. And then number 3 is a contingent business interruption piece, which we all know well, which is the insured's lost net income and extra expenses as a result of downtime that an insured's vendor faces due to a cyber attack. So while there's still room for more change and coverage enhancements to do with supply chain attacks and supply chain risk, I wouldn't say that cyber insurance is currently hollow when we talk about supply chain risk.
Yeah, interesting to hear Ady bring up contingent BI risks. Derek, there have been quite a few recent examples, haven't there?
Yeah, I mean, when you start to look at the CDK breach that affected, I think it was 15,000 auto dealers in North America, causing millions of dollars of loss. And you add to that the system failure situation that CrowdStrike brought to the table. It's really put the onus on brokers to ensure that we have adequate limits for that contingent business interruption piece that Ady mentioned. You know, making sure that we are covering both malicious attacks against third parties that we rely on, as well as those system failures. The system failure, again, a good example of that was that CrowdStrike scenario. So, you know, really this has brought that topic to the forefront. And if anything, you know, while we are typically focused on social engineering, we're focused on ransomware, some of our clients' biggest risk actually lies with those third parties that they depend on for their day-to-day business. What makes it a little bit challenging when you start to think about contract reviews is that if your client, if our client is working with a large third party like an Amazon or, you know, a Microsoft or somebody like that, when they're reviewing that contract for those services, it's very difficult to negotiate with these behemoths, right? There's very little leeway in there. We may have a little bit more of an advantage on a smaller third party where we can potentially negotiate favorable terms on behalf of our insureds. But, you know, the caution is that it can be very difficult. So we really want to have that backstopped by a good insurance policy.
Yeah, you quoted some fantastic recent examples there. And of course, Canada has seen a tripling of major cyber incidents between 2023 and 2024, over 50% of businesses experiencing events in the past year. So in light of this, what renewal and underwriting strategies should brokers be employing here to ensure both sustainable pricing and indeed client resilience? Mila, let's bring you in.
So very often, the emphasis is placed on the business and the business risks. And I think it's also important to realize the implication that this tripling of incidents has had on the employees and the clients of the impacted businesses. And this is something that comes up often in the cases that we see, where companies are looking for ways to strengthen their response. And a key part of this is ensuring client resilience through providing added value services, such as a coordination between the personal cyber policies and the commercial policies, where very often we can see that we can fill a gap and provide that peace of mind to the directors, to the HR division as they think about how to protect their clients and their most valued employees.
Of course, what role is the soft market playing in all of this, Derek?
Yeah, it's really challenging. I think if you were to put your feet in the shoes of an underwriter, they're struggling because claims are not going away. They're in fact rising. Yet, the problem is that brokers like us are really pushing them day in and day out for reduced premiums, reduced deductibles, enhanced coverage. Because if they don't give it to us, another underwriter certainly is. And so when you have 5, 10, 15, 20, 30 markets showing up to quote a risk, somebody is going to put their hat in the ring to take that risk on and deliver the pricing, deductibles, coverages that us as brokers are looking for. So it's a little bit of a tricky situation, as I mentioned, where they're trying to watch their bottom line with claims, but it's very difficult if they're wanting to write any new business to not be as competitive as they possibly can. So they're in a little bit of a catch-22 there.
And I imagine as well, Ady, that it's really putting an emphasis on brokers to get the limits and retentions right.
Yeah, I mean, in order to sort of achieve some sort of sustainability in this marketplace, right sizing limits and retentions is important. Underwriters would, of course, love to move ransomware heavy profiles towards higher retentions or even co-insurance if controls significantly lag. However, to Derek's point, given the soft market, this is difficult for them because someone else might come in and offer the coverage that we as brokers are looking for, in which case they lose the business. So right sizing limits and retentions is important when possible. Number two is allocating more limit, for example, to dependent business interruption and contingent business interruption for organizations that are dependent heavily on SaaS providers or other IT providers. Keep funds transfer fraud and social engineering sublimits aligned to what the actual payment volumes are, and really sort of tighten wordings to ensure that outsourced provider, for example, is defined broadly, include system failure where appropriate. So these are some of the things that we as an insurance community can sort of work towards achieving, but market conditions play a huge role in what's possible and what's not.
I'd like to bring up another report with you now, if I can. Coalition's 2025 cyber claims report shows business email compromise and funds transfer fraud accounted for 60% of cyber claims in 2024, while ransomware, of course, remains high cost but less frequent. So how can brokers educate clients and indeed structure cyber insurance programs to ensure adequate limits and sublimits around these exposures rather than solely focusing on ransomware coverage? Or indeed, is that the right approach to take, Ady?
Yeah, I think the insurance industry and specifically brokers tend to default towards ransomware conversations because while frequency might be declining, severity can still certainly be very high if a sophisticated ransomware attack is successful. Now, that said, not every buyer of cyber insurance is buying it for the most severe event. Some are buying it for the low to medium severity events, which is when we talk about funds transfer fraud and social engineering fraud. So first of all, I think as brokers, it's important for us to clarify the coverage nuances, the definition of funds transfer fraud versus social engineering across policies and what that actually means, and making sure that we're aligning exclusions and conditions so that there's no gaps between, for example, a crime policy and a cyber policy. Secondly, I think it's also important for us to explain the split between frequency and severity to clients. Clients still anchor on ransomware, but show them the business email compromise numbers, funds transfer fraud numbers that potentially drive more frequent losses, even if median severities are lower.
Great points by Ady. I'm just wondering, what about limit adequacy here as well, Derek?
Yeah, traditionally on the funds transfer and social engineering side, the insurers have been pretty rigid in what limits they're willing to give. Typically, if we go back a number of years, they were capping out at 50,000, 100,000, and now it is quite standard to see 250,000 being provided under the cybercrime provision. That said, in this soft market, again, us brokers are pushing the envelope as much as we can. We are seeing certain insurers that are willing to go above the 250,000 threshold, perhaps 500,000, maybe even a million or more. They're going to want to see proper underwriting guidelines in place. They're going to want to see probably a lower to medium risk firm. So if you're a lawyer that is wiring funds every single day in large quantities, probably not going to be able to get that type of coverage. But if you're more of a run-of-the-mill company, you do have a better success in getting it. In addition, we do have potential excess and non-primary options that we can rely on to try to bolster those limits where possible. And so right now it's just education. It's for years we've been telling clients it wasn't available, and now we're trying to change that tune and say that there are potentially options out there where we can get higher limits.
And what's your perspective as well, Mila? Do you believe that the dialogue has shifted?
What I can tell you is that I think the dialogue has, in fact, started to already shift. In our experience, a lot of the discussions that we're having and a lot of the inquiries that are coming through are for coverages directly related around the risks for business email compromise and funds transfer fraud. And we're looking at coordinating in a lot of these cases and offering the personal risk solutions as group benefits or as employee benefits to help relieve some of the stress that is and the pressure that's being put on businesses to address these needs. So whether it be from individuals who have been impacted in the personal line space or from financial institutions, wealth advisors, or other businesses, we have experienced an increase in demand, and the conversation has been rolling along pretty steadily of late.
Well, one thing that's definitely front and center in most dialogues now is AI-enhanced phishing attacks. They have increased sharply in Canada. One report cites a 32% effectiveness gain. Deepfake-based fraud is also emerging, especially in the financial sectors. So, Derek, how can Canadian brokers educate clients to protect themselves from this evolving risk?
Yeah, this seems to be a reoccurring question or theme. We've certainly talked about this a few times over the last number of quarterly sessions because it's not going away. I mean, it's such a AI is such a hot topic these days, and the situation with deepfakes and whatnot is only getting worse and more prominent. Ultimately, what I said last time, I'll say it again. It's getting back to basics. It's educating clients that we need to have dual authentication on any payment request. So making sure that two senior people within the company or verifying that request, making sure it's legitimate, and then obviously triggering the funds. Second, it's ensuring that there's a callback provision in any instance where we're setting up an account, a vendor account for the first time, or potentially making a midterm change of that banking detail. A phone call to a predetermined number that we know is legitimate will stop the vast majority of these incidents from happening. So it's, again, as I said at the top, it's going back to basics, getting these little things right to help our clients mitigate that loss.
And of course, this applies to both personal and commercial clients, doesn't it, Mila?
This one is very interesting because we've all heard these statistics at this point that it takes less than 60 seconds for someone to fall for a phishing scheme. In some cases, depending on the type of scam, it could be under 30 seconds or even 20 seconds. So what this means is that your assets, if you're an individual, your business, your reputation can all be put on the line for that one moment that just takes a few seconds and that error in judgment. So, again, applying both to commercial and personal lines clients, I circle back to this emphasis that if we can fully arm businesses with the options for policy coverages that can help them benefit, and this includes considering the personal cyber insurance options, which have coverages for social engineering, for phishing schemes when someone is tricked, then this could provide some very interesting options for providing value-added education, help prevent some of these scams, and assist these executives, employees, and their families for getting through these very tricky situations that are impacting all of us at an increasing rate.
I feel like I've been throwing multiple reports at you today, and I'm going to throw one more at you if I can, which is WTW's spring update for Canada, which highlighted that cyber insurance premiums had flattened or eased with strong competition and ample capacity continuing both primary and excess layers. So With that in mind, how can brokers position the advisor role now to sort of maintain that underwriting discipline, but also to respond to what is now quite aggressive competition in Canada's cyber market? Ady, any thoughts on this?
Yeah, I mean, now more than ever, it's important for brokers to add value beyond price and sort of, for example, talk about the importance of risk control and investing in cyber risk hygiene. Risk management across any sort of risk is a healthy balance of risk control and risk transfer. Too much reliance on either is inefficient risk management. So show how certain controls are proven to decrease the cost of a data breach, whether it's an incident response plan, whether it's email security, whether it's cyber awareness training, having endpoint detection and response tools. There's data out there that shows you how the implementation of some of these tools directly reduces the cost of a breach that an organization was to have. So importance of risk control and investing in hygiene is certainly something that brokers need to be talking to their clients about. In addition to that, help clients quantify their cyber risk. I think we still see an awful number of new clients that we work with that have bought cyber limits based on either just benchmarking or what they think might be the right exposure. I think it's important for brokers to educate insureds on what the right limits are for a business like theirs, whether that is through a customized quantification study or cyber analytical tools. Benchmarking isn't always overly accurate in the cyberspace. It's a good starting point, but it's certainly not the be all end all when you talk about limit adequacy for a client. So it's important to help organizations through that limit purchasing process. And then finally, claims preparation. Make sure that clients understand how to engage the insurance in the event that they were to have a security or privacy event or breach, who to call, when to call them, and what sort of information to provide them with. I think carriers are very open to also conducting an onboarding call with insureds, and it is something for both sides to be familiarized with each other in advance of an incident as opposed to during an incident. So having some of those onboarding calls is also very useful before something was to happen.
And just to pick up on those excellent points there from Ady, and to pick up on the last one of them, Mila, around claims preparation, any key elements that you would highlight there?
Yes, definitely. I think the situation that we're coming across as advisors and brokers is that very often clients are looking to see how their policies are going to respond in the event of a claim, and having clarity around where the commercial policy can respond, can provide all that added value, but where it ends and where a personal risk or group insurance policy can come in and supplement that and provide that added support could be a real key in providing that added value to the clients.
Yeah, I love that point around added value. Derek, how do we bring those value-added services to the table?
Yeah, I mean, often as brokers, we're so concerned about, getting the premium where it needs to be, getting the deductibles where it needs to be. And then all that's obviously very, very important. But in addition to the value that our individual brokerages can bring to the table through our in-house services that we offer, we should also be trying to leverage what services our third-party insurance companies can offer. They will bring in some cases, a whole menu of options depending on how big the cyber policy is with them. So for instance, if you're over 100,000 in total premium with a specific insurance company, they have a whole menu of maybe 10 to 15 options of what you can choose. And that would range anything from, MFA type keys to a tabletop exercise to, other consulting services that they might offer, discounts on software, things like that. So, and I think quite often these are very underutilized. As brokers, we get so concerned with, placing the bind order, sending the invoice, and then that's kind of where the conversation stops. Whereas these insurers are trying to bring more value, and we need to really try to leverage that for our clientele.
And an excellent panel as always. Fantastic group, this one. Remember, they will be back together one more time this year for our Q4 edition. But until then, keep it right here on Insurance Business TV.